Welcome to Budget Conversations, and we are starting this series with my first conversation with Sandeep Tandon of Quant Mutual Fund. And, we are hitting into the big event, Union Budget 2025. So welcome, Sandeep.
Hi.
What are your key expectations here?
See, I tell you, since we are student of adaptive asset allocation approach, we like to see what is the prevailing environment and how can address that. Okay. Obviously, environment is a bit gloomy. People are upset. People have lost a lot of money, and some changes which we are happening. So important focus will be for the government will be on the consumption side. Okay. If you really look at the consumption related challenges which we have faced, and it could be a political compulsion also, and it could be a social commitment also, and even from the larger interests of the economy, the consumption has to move up. So consumption will be one focus area, and this area, if I have to call it, will be more on the green energy. Basically, energy and consumption should be a very important theme, and within energy is a very vast subject we can talk about. And third, obviously, in this government has been focusing a lot on the infrastructure, though despite the last year, the spending was 13-15% lower than the planned numbers. So that could be another focus area. So these are three areas in larger infrastructure. Energy and consumption should be the focus of the budget. That's the way I read this current budget.
And that is where you see all the allocations changing and the government priorities with money will be on these lines.
I think focus should be there.
The whole world is talking about, the ignored middle class and, the bottom of the pyramid, they are being they are being served. And top of the pyramid, a prospering economy. Do you think there is any political angle to this or any aspiration on that front? Because, consumption and middle class, they go hand in hand.
Yeah. So it's a very good question, actually. If you really look at government has been, for political reason also, you can say, as a state government and so many elections we have seen, I think post-COVID, I think rural economy suffered a lot. Okay. And the good news is that we are seeing early signs of recovery. So we are more optimistic about the rural recovery, and worry is about consumption deterioration, which is happening more on the urban side. So obviously, there should be an emphasis or the priority of the government to ensure that the middle class, so-called middle class, which have actually suffering right now, be given some benefits. And that can boost the consumption. So I think some effort will be there. It is too premature to really quantify, not only from the income tax point of view, that 7.5 can become 10 lakhs, people demanding even 12 lakhs sort of thing. But I think what is very important, there we have to see gradually a lot of tax reforms will happen in this country. I think we will, if you ask me a longer term horizon, 5-10 years perspective, I think we are heading for a simple 20% tax, whether it's corporates, whether it's individual, whether it's HNI in any refined bracket or the trust or any form of any LLP structures. A lot of things will be very simpler. Okay. No short term, everything will be one number. I think it is moving in that direction. Maybe it may take few more years to move in that direction, but I think that's a broader direction. Today, the corporate tax is much lower than the individual tax. And this gap is not very good. When I look at an individual, then everybody gets into try to set up a company and take advantage and add expenses there. I think
any kind of arbitrage,
this arbitrage has to go, and that's the reason I'm saying long term everything is moving in that direction.
No, on that front, the government has already set the tone with a new tax regime, simplification, that undoubtedly, but that is also a little scary that if it's going to be simplified and 20%, then we are still little capital gains tax. Do you see anticipate any change in tax policies for the investor?
I think given the slightly gloomy environment which is there in the market for last few months now, and India has underperformed significantly, money is moving out. And if you ask me, any ray of hope is there is largely domestic investor. Given this background, I personally don't see that government will tinker at all on the short term or long term, at least in the current budget. I said, say, longer term perspective, there will be a one tax rate regime which will evolve over a period of time. But I don't see anything happening on immediate basis. The only thing, as a mutual fund, since I can only want to talk about, a lot of representation has been given to from the banking side, and that's the reason debt taxation on the mutual fund got changed because of banking, a lot of
Yeah.
money shifting. And today also we have liquidity issue in the banking system. There's a high probability, a lot of arbitrage fund we have who has a equity status, which attract
Mhm.
money, can get into a change of tax structure. Maybe it will start classify as a debt fund rather than the equity fund. That is
Mhm.
given the noise which we've seen and we saw the changes happening on the debt side, maybe high likelihood that this also can be considered that could be partially negative for the mutual fund industry in general.
Mhm. Uh, yeah, it will actually require a very creative, because the way the arbitrage funds are designed, uh, legally they are, the character remains a fixed income, but
Yeah.
but legally it is very difficult to not classify them as equity. So it will require a very creative drafting of the regulations or the tax laws to redefine them, these arbitrage fund, as fixed income.
Yeah, maybe they can change. They have that this taxation is ultimately their the CBDT have an authority to reclassify these things. You know how the changes like last year also new category came between that like hybrid category, a new taxation law came into picture.
Mhm.
So something can they have done it. So I'm not saying that is happening, but I think given the way liquidity is moving out from the banking system toward this way, this is the one sort of added benefit the industry has. Possibility is there. I'm not saying
Yeah.
I'm saying given the noise and given the
Is the arbitrage or those hybrid component, is it a very significant part of the money mobilization or the fixed income allocation of
yeah, it's a very
larger
I don't know
investors?
the exact numbers, but it's a very sizable
Okay.
numbers. And when market actually correct and consolidate lot many HNA family office actually
Hmm.
move out their money and they instead of parking money in the liquid side, they actually move to the
Yeah.
arbitrage side purely from the taxation angle and when they want to flip. So this is one area which I have some amount of concern given the
Okay.
noise what we are hearing about.
So it's effectively, anti-mutual fund lobbying at its, yeah, working overtime.
Yeah, I think I will not call it anti-mutual fund. I think what government, you look at from government perspective. Government has
Hmm.
to play fair. You can't say that, in the past we have seen, the beneficiary was benefit was given to insurance company and mutual fund used to crib about it.
Yeah.
And today
Hmm.
some insurance companies are cribbing. I think they have, as a government, they have to balance it. Okay.
Hmm.
And I see that within financial sector, both insurance point of view, insurance fund, mutual fund, even pension fund, and the banks are important there, including NBFC, are very important player when we're talking about overall money supply angle perspective. And we talk about, if you talk about that you capture the pseudo banking thing also. So I think
Yeah.
this is a very important data. So I think the treatment has to be fair, and I'm sure government will look into it more from a fairness perspective rather than saying one industry. We may say it's anti-mutual fund because we are part of that industry. Okay. But
Hmm.
from government perspective, I think they have
Yeah.
to balance it. If banking sector channels are complaining and they see merits that money is moving out, because
Mhm.
ultimately we need capital in the banking side also to fund large infrastructure. So it's a act. Let's see how it happens.
With Trump back in the White House, how could India's trade relations and key sectors be impacted by, potential shift? And, do you have any kind of tweaking in your model to, accommodate the changed regime there in from an Indian investor's perspective, as you being, managing the scale of money now?
Yeah. So, Dhirendra, the way we look at, first of all, I'll answer that your point, how we capture in our models. the most important aspect we have to understand is that the Trump, I always say, is not a what do you call it? Not a politician first. He's a businessman. Okay, and
Mm-hmm.
he's a smart businessman, and he is doing business for a while. So I think it's a good to have a person like him at the helm of US in a difficult or changing environment. Okay, and if you really look at one important thing which we have been talking right from November, that geopolitical volatility will come down post Trump taking the oath. And we have
Mm-hmm.
seen the settlement. We were very early to spot that because given the personality he is, and
Mm-hmm.
in some of the geopolitical cycles we track. We have in our book also, if you go and check, we have showcased that J curve in the how geopolitical volatility will start spiking from 2019 end till 2025. Now is getting plateau sort of thing. So geopolitics,
Mm-hmm.
though overall macro situation still remains slightly grim from a global perspective, but geopolitical volatility will come down. That's a very important development for us from a risk perspective because this is one of the biggest unknown risks. If one biggest
Mm-hmm.
risk can come down, today we have a short-term challenges we'll talk about, but from a, if I have to take, let's say, 4 years perspective, if I know next 4 years the geopolitical volatility will going to come down, I think there's a one big unknown risk we are able to address. So very constructive background which is there. Second most
Mm-hmm.
important point of view is that Trump being a authority person, and we are in good books of US. At least we are not on the negative list. That it's
Mm-hmm.
a very constructive thing for India in long term. But like any leader, he will first look at the interest of US. Okay, and I
Mm-hmm.
think what is very important to understand this tariff angle, not only in absolute terms, because see everybody is looking at just absolute terms. So the this will move up. See, also last time also
Mm-hmm.
when he raised the tariff, what China did very smartly, he depreciated the currency. Hardly any impact was there. So China
Mm-hmm.
used currency as a weapon to manage that. Now, what is important for us is that look at absolute number is good. How the world will react? How will be the relative impact? If the penalization
Mm-hmm.
on, let's say, towards Mexico, Canada, or even China is more than India, we are in a better position. Okay,
Yeah.
don't just look at in isolation. But to be very fair with from a Trump perspective, in certain areas, I do expect that tariffs will increase where we have some sort
Mm-hmm.
of arbitrage between China and India. And because of some of the tariff reason, we are playing that game. It may not last for long. But some of the spaces like, let's talk about pharmaceutical space, okay? Some of the specialty chemicals, where India has some edge in terms of quality, okay? I think those are the area in US there's a shortfall. I don't think that you can generalize that part, that everything will move up. So so it has to be sector specific call we have to take. And what is also very important to understand how it will impact the yields and the currency market. I think I have multiple
Okay.
channels I have been talking about. The 2025 is not about equity market. It's not about just geopolitical. It's we have to closely assess the volatility in the global yields, particularly US, Japan, China, and and the currency market. And yields and currency market have very deep interlinkages. Now look at
Mm-hmm.
China. China interest rates are declining. Okay, their 30 years interest rates are lower than Japan 30 years. Okay, which we have never visualized. Now,
Mm-hmm.
many people don't track these things so closely as a macro house. We look into these data, it has a lot of ramification. Okay. And can, when China is trying to build, let's say, a global currency spectrum thing, or reserve currency status, which they have not been successful, can they do use the shortcut and try to create a reserve currency? If they can't create a reserve currency, can they become a next carry trade in the world? Okay. By bringing down yield thing. So it's moving in that direction. I think you cannot ignore China. They are very intelligent people, very strategic thinker. Okay. So I always say you have to monitor China very closely. Today, if you look at, since we are student of global liquidity, in last 12, 15 years, when China relevance has actually improved, let's say from 2000 onwards, and in fact, last few years it actually deteriorated in terms of relevance. But in terms of global liquidity, they still provide 65% of the global liquidity in the market. So it's a very important
Mm-hmm.
country you cannot ignore. So a lot of
It's a
people have
money.
ignored 30 years yield will change. I think something we have to be very watchful.
Mhm. So what's the global, liquidity and risk appetite indicator suggesting right now? Of
So
course, they mentioned about this in the Chinese context.
okay. So let's look at, if you recollect, we were very early to talk about in July 2024 itself that India macro has started deteriorating. We were able to spot through proprietary knowledge and a lot of high frequency data, which we kept. I don't think any economists or strategists talked about deteriorating India.
Mhm.
We are in similar situation where risk of parameters have started peaking out. And if I have to say, our complacency indicator for US is was one of the highest level, which means the complacency is one of the highest level. Money flow towards global money flow, if I could say, towards US equity is one of the highest levels, which means the vulnerability of US is very high. Okay. Now,
Mhm.
when I talk about vulnerability from a not from a long-term perspective, we are very constructive on US economy, both from absolute and relative basis. I think under Trump regime, the economy will go to the next level. But we always say in the market what is priced in and what is not priced in. From a behavior
Mhm.
perspective, what we have to understand, all hype and all good news has been priced in from a medium term perspective. When I say medium term
Okay.
perspective, let's say 1 quarter perspective, it has been priced in. So India, US is in a similar situation what we were in July 2024, which means US vulnerability is high, which means US market can correct more than the Asian market and they can correct more than the India. Okay. Now, obviously, the first question comes, if US market is going to sneeze, is going to impact other people. Yes. Okay. But on relative basis, India has potential to outperform US from a quarter perspective, okay, or from a medium term perspective. Because if I look at India risk appetite, in fact, last month we have also said that that now from a mild risk off in July to major risk off in September, October, we have re-entered a mild risk on period, which means
Okay.
that
Okay.
from India perspective, because this questions a lot of people have in mind, because risk appetite is very closely linked with the small cap stocks and the mid caps and small cap in particular. What we think
Mhm.
that we it has already covered 60% of the journey from July 2024. And if I have to
Mhm.
mathematically extrapolate and say how long it can last, my personal sense is maybe by March end, beginning April, mid-April sort of thing, ideally this risk of cycle should peak out, which means
Okay.
the risk on momentum can risk on rally, the mild risk on thesis which we are talking about now can gather momentum at that time. So till then there could be a small pain, okay. But
Mhm.
how I look at, a lot of people are concerned now about mid and small. We were very early to highlight about that pain, and that's the reason we underperformed also for some time, because we skewed our portfolio towards large and mega large. And I'm saying in 2025 belongs to large and mega large cap. One of the very simple thesis, purely on our predictive analytic thesis, we have been saying that last 4 years we have seen mid and small outperforming Nifty. I think 2025 mid and small will underperform Nifty, and large cap will outperform mega large will outperform large, and large will outperform mid and mid will outperform
Okay.
all. That's the way I define. Now, question comes how you read it from absolute basis. Relative aspect is very clear, and that's the reason when
Mhm.
we look at Quant into our reality framework, our entire
So what you are basically pointing out that normalcy will be back.
I think it should bottom out, or let's say risk of cycle should peak out. So ray
Mhm.
of hope, okay, will be back, and that's the reason I'm not that bearish on small and mid. Like a lot of people say, long-term tops are in place. I'm not in that camp,
Mhm.
but we have
Okay.
seen euphoric move in some of the sector in IPO, certain private space, a lot many
Mhm.
sectors. I think it needs to get corrected without cash flow. People were giving numbers, an absurd number in terms of
Mhm.
revenue times and all those things. So we are value investors. We never uh, felt like buying some of this new age economy. There was no cash flow, but anyway, market was looking differently. Now cycle has reversed. So
Mhm.
I'd like to be clear on that front. This is not at the peak of the long top of
Mhm.
India on small and mid. A lot of question comes to us. So I thought I'll use this opportunity to explain that.
So near-term happy days are postponed till April, is what you're saying.
Could be. I'm not saying so one has to be selective. I think many stocks have given a signs of capitulative. And I always explain this example how in 2020, when we talked about that erstwhile, in those
Mm,
days, admired territory stocks, if you recollect, like how Bajaj twins, DVs, or, many
yeah.
name D-Marts. I'm just saying
Mm,
namesake,
yeah. Yeah.
many FMCG name, consumption name, they were all at absurd valuation. Growth at any prices was the thesis which was playing out. Okay.
Mm, mm,
And in 2020, we talked about how next few years belongs to the most hated zone and sell that
mhm,
admired territory and buy hated zone stocks. And they did very well. And that's the reason 2020, when we talked about value thesis coming back, okay,
mm.
versus growth. Now reverse is happening. Erstwhile neglected admired territory stocks are
Ignored issues.
now
Yeah.
are not hated zone, they are in the neglected zone. So my
Mhm,
risk reward ratio is more favorable in the FMCG names, okay, the Bajaj twins of the world. Some of the all, even including some of, and again, namesake, I'm giving examples so you understand the interpretation, not looking at the stock recommendation in any manner. Okay.
mhm,
So those are the stocks which is gives me better risk reward ratio. And last 2 years, 3 years, admired territory stocks should be avoided. They have all have peaked out from a not only from a medium term perspective, maybe from a longer term perspective also. Many stocks have peaked out. You may not see those prices
mm.
coming back
Coming back
for a
again.
period of time. I'm not saying ever, but longer period of time.
So this is a period of churn when we see all kind of rotation. What was in favor will go out of favor.
Yeah.
What was ignored will actually gain prominence, and in for. So what are the key risks for what is the primary risk that you anticipate for Indian equity right now? Is it the bad weather in US, or because it will be they are vulnerable, they will see and they will be looking for markets at these occasions, they look for an excuse. What we witnessed yesterday, something else happened and the whole market tanked, and so severely because of a particular segment being completely fundamentals being completely out of whack there.
So there is in fact, last few months in our monthly call, we have tried to explain the biggest risk for India is our high expectations. Okay. Last
Mhm.
4 years, the expectation level has moved to the next level, and people used to be very happy with 12-15% returns. Now, if you talk about recommend that we can get 15% return, it looks like, something is not right with you when I'm talking about 40
Mhm.
return. So the key, that's the reason I'm calling this as a risk, because our own
Mhm.
expectation is so high. And if you are not able to achieve those number, what, because your benchmark has moved up in last 4 years. I think that
Mhm.
benchmark has to come back to the normal levels, like how interest rate become negative interest rate, and then from negative interest rate, if US becomes 4.8, 10-year yield, it should not, because from negative interest rate become 4.5, it looks very high. But that was the
Yeah, yeah.
normal interest rate used to be like this in the past. Okay. So that is the one, the expectation has to be reset. That's the first important thing, is a psychological number. Whether you are investor, as a money manager or wealth manager, or as advisor, or as a writer, you have to prune down those expectations. That is the biggest risk. Second risk, which I felt last year, a lot of regulatory changes happened. Okay, how
Mhm.
the limits on the F&O side has moved out, the risk which was a regulator highlighted in the mid and small, and some changes happen about the derivatives market. Net, the operating cost has moved up. Okay,
Mhm.
which is the bad news for the traders. But if you look at the institution where we got affected, is the impact cost has moved up. Okay, the
Okay.
impact cost has risen sharply. Okay, in last many
Is it
months.
because the market has become shallow?
So no, it started with the regulatory changes, and any regulatory changes takes time. See, we have seen so many regulatory changes. We are not getting into the reasons for that right now. What we're saying, anything new happens, market takes some time to adapt. And that's the
Mhm.
reason the
Okay.
first impact is that if you have to unwind your follow position, or particular index is no more traded, or number of stocks has come down, so it changes the dynamics. Okay, the
Mhm.
arbitrager were providing liquidity, now they have gone out of the flavor. So what it means, net, my impact cost has risen sharply, and that's the reason you see the churn in the market has also come down, because if I want to, let's say, shift from one sector to other, or one stock to other, And even the large cap stocks, if you buy a size and the price moves up 8, 9%, you sell, price goes down 7, 8%. So effectively, you're talking about 15 to 18% impact costs, okay, in the liquid
Mm-hmm.
names. Forget small and mid, there's no exit, okay, in some of those names, what churn we are talking about. So
Mm-hmm.
that becomes a very painful, okay.
Mm-hmm.
And my sense is because a lot of MFI guidelines also came, a lot of mutual fund industry was very worried about those regulation which came, and dealers was worried, fund managers worried about, because it generates trigger, okay, alerts if you are slightly away from VWAP. So effectively, new environment, new change, it takes time. So what happened? Everybody started following that, and it has a huge impact on the market. And now it is settling down. Maybe by March end or so, lot of people system gets built. People, you get used to it happening this way, the new way of doing things. Okay, so any change which happened takes some time, and that's the reason this time when the fall happened,
Mm-hmm.
the impact cost has done more damage than the actual buying and selling. Okay,
Okay.
the damage is because of that, and this is something mathematically we have decoded, and we were very early to highlight this problem, and that's the reason our portfolio is very liquid now.
But all the thing that you are referring to, that the liquidity has gone down or the impact cost has gone up, is it particularly much more damaging or a deterrent for the strategy that you were pursuing, where with a very high turnover, because you changed your view and you changed your portfolio? And is it really a little more unfavorable for you for the strategy that you pursued?
So up to small extent, yes. Okay,
Okay.
but what happens, we are student of numbers.
Hmm.
I always say we are student of adaptive asset allocation as a thesis. We adapt. Sometimes you have
Okay.
to gauge the market. Okay, you
Mm.
should not be in a hurry to do it quickly. Like last 6 months was a good learning how the environment has changed. We were very early to spot that change, okay, and
Mm.
we are beneficiary. So sometimes Dhiren, is very important to lie low also. It's not necessary that
Yeah.
every time you have to play on front foot. I always say in risk on environment, generate
Hmm.
extraordinary alpha, which will help you in a difficult environment. We always say in risk on,
Mm.
the returns are first priority, liquidity is second, and safety is the last. In risk of pace, which
Mm.
was the case for us in last many months, or for the market also in general, safety is first priority, liquidity is second priority, and returns are third. Okay, the
Mhm.
equation changes. But in a risk of period, if you want to cover your underperformance and try to take risks, that's the way I have seen maximum damage happens. Okay,
Mhm.
sometimes you are lucky that your strategy will work very well for whatever circumstances. Let's say it was working very well in the small cap, or particularly let's talk about IPO market. Okay,
Mhm.
low liquidity, lock-in periods, easy to take the prices up because supply will not come. So very pragmatic way of managing returns, of generating alpha. This was a very,
Mhm.
I'm very candid in my opinions. Okay, this
Mhm.
was the thesis which played out very well by all the market participants. Okay. Now suddenly it has reversed. So what we
Okay.
have to gauge that how well you manage in the changing environment. And since we are a data-driven house, analytic firm, we adapt very fast. And sometimes,
Mhm.
if you are unable to see those changes happening, we have to wait and watch. That's the reason in many of our scheme, we parked our money in largely in the liquid name, and maybe towards large cap and the mega large cap, because I have preserved the safety. When cycle will come in a risk on environment, we will very quick to move. Let's say I always say, let's say if I have to shift from large to small, I might take week 10 days. Okay.
Mhm.
10
Okay.
days I can
Okay.
shift, but other way it might take 10 months to shift from mid and small to large.
So you are maneuverable enough even now.
Yeah, 100%.
Okay.
Sometimes
Uh,
you know to take two step backward and
mhm.
analyze and assess the situation rather than saying that I will follow the same strategy what I followed in the past. It's not necessary. The environment has changed. We are very quick to change.
Now I have come to the last question, which is the most important question, because you have emerged as a very prominent player by betting on themes and context. much ahead of, being ahead of curve, and played it on front foot. Uh, what are the themes, or what are the current things that you are betting on? Stories, themes, or context, or a particular segment, anything which will be profitable for investors, or profit or good for investors to peep into what to expect from your fund.
So if you really sit down and analyze our portfolio, you will get a perspective. Our overall portfolio is more skewed towards A within the thesis are than mega large, and within from the sector perspective, we are skewed towards energy, and there's a theme which we think is a decadal theme. So maybe by 2030,
Mm-hmm.
30, theme should play out. So energy, followed by consumption, and within consumption, we are more skewed towards stable in a big manner because most of the
Okay.
stable companies or FMCG companies were now in a neglected territory, though they are not very cheap. Okay. Okay. So a lot
Mm-hmm.
of people get into this argument. I always say we are not a just value or growth investor. We are very strategist, or we buy and sell a stock on the
Mm-hmm.
inflection point. So that's the area which we like. We like hotels and hospital as a theme. Okay. If you
Okay.
don't really both hotel and assets, if the insurance sector is growing, disposable income is rising. I think insurance and
Mm-hmm.
hospital going hand in hand. And we like insurance also. It's been in the neglected territory for a while. So insurance is a sector which we like. Hospitals we like. Other area which we have started building a large exposure is hotel sector. Okay, how
Mm-hmm.
few years back realty came back. Realty was one or two
Mm-hmm.
IPO happened, and now it's a very large sector. Something similar we are seeing in the hotel space also. So if India is going to grow, tourism is growing in India, business is growing, irrespective of the market for time being, you hardly get any hotel
Mm-hmm.
space. The celebration that moves along, the destination wedding thesis that's getting built. So I think that's the
Mm-hmm.
one area where you have physical assets and you have huge cash flow. Free cash flow generation is
Mm-hmm.
there, and a lot of hotels are now moving in the asset light model also. So that's our area which we like. Then I still like larger infra theme because India is a growing economy. We need infrastructure,
Mm-hmm.
irrespective of whichever government come at the state or the central. I think infra is the focus, will remain in the focus. So larger infra thesis is something very
Mm-hmm.
important. If India has to grow, then we still like materials. So you can be very stock specific. Materials is also area which we are adding and building selectively in our exposure. Very specific themes we are playing where we think these are the themes which are relatively underowned. Okay,
Mm-hmm.
not appreciated and admired by the market. So we
So
are
they are basically narrow themes which are ignored, and they will play out for their special
yeah,
situations.
under own valuations are attractive, cash flow generation is very good, and these are the things where earnings can multiply much
Mhm.
faster than the other markets, other companies.
Thank you very much, and I look forward to having a conversation again post budget.
Yeah,
Thank you very much
thank
for
you.
your time and
Thank
the
you.
insightful thing as always.
Thanks a lot.